Awesome. So, just like that, we're now recording. Matt, I'm excited to dive in. Why don't we start this conversation, if you will, by giving a description of what Moves is trying to do in the world and what the spark was that you guys had when you started the company?
Yeah, totally. I like to describe our business as a digital credit union for gig workers. And uh, the word credit union is not something that people could typically associate to like cutting edge technology or even the fintech space in general. I mean, you hear terms like neobank or challenger banks, but there's something about serving a very specific demographic of people that have like a very similar walk of life every single day that just felt like it had really good historical analog to like the credit unions of like the old farmer communities and specific types of people that have a specific set of problems that came together effectively to solve those problems through financial services. And so actually the picture behind me on the wall on this side is the first credit union in North America. And it historically had been this idea that people that made a living the same way would come together to build very tailored financial products to the way they made a living. So you think of like farm communities where you needed lending products to finance the purchase of like farm equipment. Maybe a big bank in New York would not finance that equipment, but your local credit union would because they understood what being a farmer was all about. And so gig work felt quite similar. It felt like there was very unique problems to a very specific audience that were not being addressed by large scale financial institutions. And so we decided to sort of really narrowly zoom in to only people who earn their primary living in the gig economy and figure out what were those problems that they experienced uniquely and how could we solve them for them. So that's what we've been building.
That's cool. Where were you sitting? I mean, what were you doing where you realized this was an opportunity?
I mean, I think like a lot of ideas, it comes together over a series of like interesting insights and like increasing your like in your depth and knowledge in a particular field. But there was like very specifically a couple of moments that stand out in my mind that were in the back of Ubers, sitting and talking to drivers as I would regularly do, just asking questions about like, where they're from and how they like being an Uber driver. And there was one conversation in particular, it was sort of late 2019. I was talking to an Uber driver in Toronto where I'm from, and just hearing about just the shit that they deal with to make a living. There was increasing tensions happening between Uber drivers and Uber. They felt like they weren't getting their fair share. You'd hear this from drivers all the time where they knew that you were paying a fare for your ride, but they weren't getting their fair percentage of that fare. Uber was taking larger commissions, things like that. And I remember so we were chatting about these things. He was pretty open and transparent about like how difficult it is to plan for his family and put money aside for his rent and things like that. And so it sort of prompted me to go dig around and figure out if anybody started building financial services for this user base. And then the next couple of weeks, that was like user research for me. I just kept getting into Ubers, not because I had to go anywhere, but just because I wanted to drive around the city for 20 minutes to talk to somebody, or ordering food and like stopping the person at my door and be like, I'll give you an extra $5 tip if you like answer a couple questions for me. And so I just like kept validating that this was a universal set of problems that, at least in Toronto where I live, people were experiencing pretty regularly. And, then we started formalizing that into a business.
And how does a driver, say anybody that's working on a platform or marketplace, we'll just lightly define it.
Yeah.
How do they come to the conclusion? Like, what do they use to draw the conclusion that they're being unfairly compensated for their work? There's no standard, so many of these tools are brand new and there's not much to compare to other than just what your hourly rate would be working at more brick and mortar type shop.
Yeah.
Typically for low skill people that don't have that the job doesn't require a lot of skills to get into it. How do they draw that conclusion of fairness? Like, where does that come from?
I don't think it purely comes down to like fairness of compensation. I think it was fairness of like how they were being treated across the board. And so sometimes fairness was certain people in the gig economy feel like they could be getting paid more. But sometimes fairness is transparency. Like, how do I know that the tip that I earned from my customer actually came to me? Like, there was some stories not that long ago where DoorDash was keeping percentages of tips, which just felt like a pretty like unfair practice. Like, the tip was directly on the back of like the quality of service or the smile that you gave at the door or like something that left an impression with the customer. They turn around, they give you a $5 tip in the app. unknowing to the customer, some percentage of that was going to DoorDash. And DoorDash ended up reversing that policy after they got a lot of pushback on that. So I think fairness came in a lot of ways, right? We hear all the time of Uber drivers and Lyft drivers getting deactivated from the apps for reasons that are sort of hidden to them. So all of a sudden they're relying on this app to make a living, and then one day to the next they've broken some policy that they were unaware of, and they get kicked off the app, and now they can't earn a living anymore. So fairness was like across the board, like not having a way to have your concerns prioritized by these companies. And so the trade-off that a lot of these workers have had to go through is they've effectively de-risked themselves by like diversifying across multiple apps, right? So the Uber driver who also drives for Lyft, who also drives for DoorDash, who also drives for Instacart. A large portion of that is to make sure that they're never in a position where they're just on the receiving end of a bad deal. They can go around and shop for better deals, right? So if Lyft is providing better bonuses today, or there's better surge pricing, they won't drive for Uber, they'll drive for Lyft. And so that's how they make up for it. But it's effectively been like a way for them to game the system to find sort of a meaningful way to earn a living, but not with as little reliance on a single platform as possible is sort of the conclusion that we came to.
That's it. There's so many roads I want to go down. Before I ask you more about your thoughts on how people should and can collectively get together to bargain or have a voice, what were you doing prior to this? You were sitting there feeling like this is the thing I want to spend the next, however many years it takes. Do you have a background in payments, or do you have a background in? Tell me what your interests were prior, or what you're working on.
Yeah, probably a little bit of an unorthodox background to come to this problem. I mean, so twofold. One, my like formal education and call it real job was as a CPA at Deloitte. I was a trained accountant. I used to work in international tax consulting. That's not where I got my inspiration to build this product by any stretch. I left that back in 2016 to start a company in the crypto space. And so I got really deep into sort of the world of cryptocurrency and the early days sort of before a lot of the hype around like decentralized finance and NFTs and everything that people are talking about these days. But what really attracted me to that industry was this idea of like democratizing access to financial services, democratizing ownership for demographics that historically did not have access to ownership. It was a new set of rails and tools to be able to build, more tailored financial products. I think what got me a little jaded, frankly, I spent about 3.5 years working in the crypto industry very, very explicitly. I went through a lot of the ups and downs of that industry. And as much as the principles and the philosophies behind that industry really excited me, in practice, what I found was that it was a lot of people looking to get rich quick. It was a lot of people looking for a quick payout. It was a lot of it was a market driven by speculators to a large extent, rather than the end users who should ultimately be the beneficiaries of a new technology. I think that's changing. I think if I look at the crypto industry today, I see a lot more signs of like real positive developments and like real meaningful change that's taking place. But back in 2019, when I decided to sort of pivot my focus in my career, it was with a view towards, going to find a actual user base that had these problems in real life and building a product or a set of products that solve those real life problems. And that's what sort of took me into this space. I'd been paying attention to, in 2019, you might remember, the gig economy was like littered with news around lawsuits and labor movements and boycotts and protests, all surrounding this idea of like gig worker treatment and fairness. And there was new laws being debated in California around, should gig workers be treated as employees? Should they be independent contractors? It was a very topical issue in 2019, so naturally it caught my attention. And then I just started like digging in a little bit more deeply over the course of the subsequent 6 months. But now it's been about 1.5 years working on this.
Yeah. I remember when the topic of conversation was huge around this. Like was it 51, AB 51?
AB 5. Yeah.
And that passed,
it passed. And then, so AB 5, Assembly Bill 5 was a California law that would effectively classify every freelancer and independent contractor in the state of California as an employee of the apps or online marketplaces that they were earning a living from. So this included like freelance designers on Upwork and freelance web developers, as well as gig workers and, the whole gambit, photographers. It was a pretty controversial law. It was sort of debated throughout 2019. It came into law on January 1st, 2020. it didn't take very long for Uber and Lyft to sort of lead a charge to say, if this law holds, we will exit the state of California. We cannot run our business within this construct. They then spearheaded a proposition called Prop 22 that was a ballot box proposition for the November elections in 2020, effectively to reverse AB5 on the category of independent contractors that were gig workers. So if you worked for a rideshare app or a food delivery app, then AB5 would exclude you from its new rules so that these platforms could continue to operate on the basis that they were just connecting supply and demand for a service, right? So on the one side was this worker supplying a food delivery service, and on the other side was a customer looking for a food delivery service, and they were just like the matchmaker in the middle, or so they wanted to be. I think what really highlighted the issue for us was that there are consequences to being a gig worker that have gone unaddressed, right? So gig workers, unlike freelancers, do rely very heavily on one or two or three sources of income, very similar to an employee sort of relying on their employer as a source of income. But they had characteristics like they could leave whenever they wanted. They could switch apps hour to hour if they felt like it. And there was no like penalty for these things. And so it highlighted that employment was maybe not the right classification, but nor was pure independent contract work. There was some like gray area in the middle. And Uber wasn't going to take it upon themselves to solve all these issues, and nor were the laws really well designed to do anything. So, the original thesis was there needs to exist a product that explicitly looks out for the best interests of gig workers. They weren't getting that from Uber. And so we decided that we would be the product that just builds to their best interests, whatever that means, wherever that takes us.
Wow, that's a great explanation. That makes a lot of sense with good history on Uber and Lyft threatening to leave. Did that, and we're now November 2021, is the AB5 is still in place, and there's an exclusion for people that are working on platforms that have like specific jobs as opposed to, what's the major complaint that people who are doing freelance work as like a writer for a blog are now being classified in a strange way, or what are the negative?
Yeah, and a lot of it you found is that people that were falling under this new rule, they had been polled many, many times throughout the last like 2 years. By and large, like an extremely large majority, like 70 to 80% of people that would be reclassified under this law did not want the law to exist. If you were a freelance writer who was writing for Vice magazine and TechCrunch, and all of a sudden to be forced into the classification of employment, when you have like chosen to take the path of independent contractor, you've chosen to sort of be your own boss. It had a whole bunch of trade-offs that most of these people didn't sign up for. And so there was a lot of pushback. The specific rules of Prop 22 were only to overturn gigs that were specific to like rideshare food delivery type apps. So like Instacart, DoorDash, Uber, Lyft. So there's a category of apps that were excluded from those rules. It's not over. The debate continues because Prop 22 then came into effect shortly after the November election last year. But then since then, in the last couple of months, Prop 22 has been pushed back into the California court system as an unconstitutional proposition. And so now and it's generally being spearheaded by like labor unions saying, hey, this is like a cute way for Uber to like avoid its responsibilities as an employer. And so now it's back in front of the courts. This is all unique to California. There are a lot of other states going through similar debates. Massachusetts is going through a proposed bill right now around the classification of gig workers, and we expect that every state will probably follow suit. But it's clear that nobody's really found the exact right answer yet. So,
and the two different sides, or the two forces, are the companies themselves, Uber, Instacart, Lyft, those guys. Then there's the workers on the platform. Then there's the people who are kind of caught in the crossfire, like bloggers at TechCrunch, and then there's the unions, the groups of people who are organizing together to advocate for usually not gig workers. I mean,
yeah, and so this is maybe a cynical view, but because I like to think of our business is a little unique in the sense that, on one aspect, we are competing with like banking products. Like we'll try to acquire a customer who happens to bank with Bank of America, and so we're competitive to Bank of America in that context. In the other context, though, we are effectively aggregating gig workers to build like a representative voice for gig workers. And so the other angle of competition for us is labor unions. Labor unions have not historically represented this industry. They have tried to like inject themselves in the conversation as effectively like a proxy for the voice of the gig worker. The reality, when you dig into it, though, is that there is no labor union in the country that has signed up any meaningful number of gig workers to their union, right? So they're all saying, hey, if the laws go this way, I think of labor unions almost like businesses, where if a new industry is forced to go down this path, then labor unions now have a new market share that they can sort of grow into. Right now, you can start charging membership dues and things like that of gig workers to be part of like collective bargaining agreements and whatever. Whether or not gig workers want to is sort of a different issue. And so the problem has been that the people speaking on behalf of gig workers are not actually gig workers themselves, or are not actually talking to gig workers themselves. And so it's been this debate between Uber and labor unions, like sort of posturing that they are the voice of the gig worker without actually a link back to the gig worker. And so we've been trying to fill that gap to say, well, if you're going to start advocating for things that gig workers want, you should probably ask them what they want, and then make that the topic of advocacy, right? Because gig workers, by and large, it's 70+% do not want to be classified as employees, but every labor union out there is advocating for employment status. And so it feels very self-serving from that perspective, as opposed to like actually doing what the gig worker wants or needs. And so we hope that we can sort of take a different approach. But
yeah, wow, it's super interesting. So I find this whole cross section of private companies and individuals working and governments and unions, like they all meet together, it's important because it represents where we sit philosophically as a society, and the role of governments and the allowance of groups to get together to represent workers. And certainly the companies have their incentives, which are clear. But throughout history, this has been a point of contention where, like the classic factory has such a dominating influence or power over the worker. People use the word exploit. I don't love that word, but it reflects the idea that the centralization, the person paying the worker has an imbalance of power or imbalance of control over the worker. Obviously, no one's enslaved. Anyone can just quit and work for another company. So there is, I think, a beautiful component of the free market capitalistic playing field. And then the question is, you start there. You say anybody can offer any service, and you can either work for them or not. And then we say, well, why does that not work? Why do we need other things on top of that? And I think I think of it as like the worker wants what do they ultimately want? They want a consistent deal. Like when they sign up on Uber, they don't want it to change over time if they make investments in this. Like, what do they?
I think that's part of it. I mean, I think I like your historic framing, because I think that's exactly right. Some of the constraints historically, like if I point to the number one innovation in the gig economy as it relates to labor, has been this concept that, some people in the gig economy call this labor liquidity. Historically, you might work for a factory. You might say, hey, the free market will have its will. Like if I'm not getting a fair deal out of my employer, I can always quit and go somewhere else. The reality was that in quitting and going somewhere else, there's a huge amount of friction. There's a huge amount of like labor illiquidity. Like I have to quit my job, take the risk, look for another job, get trained in a new skill, whatever. Maybe the market that I live in happens to only have a small number of employers. And so as much as that was an argument in favor of just free markets, the reality was that workers didn't always have a lot of optionality, right? So labor liquidity in practice, and this is where I think we need to push the gig economy platforms to actually sort of fulfill their promise. In practice means that there is little to no friction that exists between a worker and unlimited choice in type of work and source of work, right? So a driver who drives for Instacart on a dime could turn the Instacart app off, turn the Uber app on, and be working for Uber a minute later. That concept historically didn't exist, right? You can just like stop working at one factory, go to the factory across the street, come back an hour later. But that's exactly what the gig economy is from the worker's perspective. In reality, Uber, Lyft, DoorDash, et cetera, they've all tried to put up some like obstacles and sort of walled gardens around their services to make it more difficult for workers to do that. And I think the onus should be on forcing them to actually evolve towards pure labor liquidity, where the worker has 100% flexibility. Because then I think the free market can actually play its role. Because if a worker is unlimitedly flexible, then Instacart's going to have to compete with Uber for drivers, and DoorDash is going to have to compete with Uber for drivers, and so they're all going to be bidding up. And the worker all of a sudden is now in a position of leverage where they have options in front of them. which means wages go up and benefits go up and perks go up. I think that's sort of the reality that we would be advocating for. That requires Uber to be forced down that path. That could be things like Uber does not allow a driver to own, quote unquote, own the profile data that they accumulate within the Uber app. Could be their star rating, right? When they leave Uber after years of service with a 4.9 star rating and they start driving for Lyft, they start driving for Lyft with a 0-star rating or a no star rating, right? So why does that data not belong to the driver? So that would be like an example of labor liquidity being encouraged, right? And that's where I think these platforms are trying to have their cake and eat it too. They're trying to say, hey, for purposes of employment classification, we don't want to be your employer. But when it comes to like locking you into our platform, we want to make it really, really difficult for you to go work for our competitor. And so those are, contradictory positions that I think, maybe legislation will play a part. It just feels like legislators and unions have been sort of addressing the wrong issues. They're not addressing sort of the fundamental root issues. They're addressing sort of like symptomatic side effects. And that's where I think we're creating like bad outcomes for everybody with like AB5 in California.
Yeah, really good example with the data. Do you think it would be enough? Like, tell me why this does not work. Is what if Uber said to its driver base, hey, come work with us. If you don't like it, we'll give you all the data. We'll allow you to easily export all your ride history and your ratings, and you can leave and go do whatever you want. If they were to say that, that would make them more valuable from the driver's perspective. Yeah. Is that not happening in practice for some reason, or is it just?
I think they will get there. I think that's sort of that's the position we tend to take, is that eventually they will realize that this is in their best interest, because one of the biggest costs driving either losses and or like limited profitability for these companies is the amount of money they spend on replacing workers that have left their apps, right? So they spend hundreds of millions of dollars a year on just worker acquisition, knowing that they're churning out huge number of workers. So when we look at this from like a macro perspective, we say, hey, if we can actually solve problems for gig workers are more likely to stick around as gig workers for a longer time. Therefore, Uber is less likely to have to spend on constantly replacing that driver. Uber loses something like 80 to 85% of their drivers year over year.
Wow.
The number of marketing campaigns and acquisition campaigns they have to run just to replace that workforce to maintain sort of a balance of like supply and demand in their market is astronomical. And so that's where I think they're short-sighted to a certain extent. Like they look at it from like, this year's perspective. They don't want to lose drivers to Lyft. But both of them are facing this macro issue of like, what if all the gig workers just decide the gig economy is not sustainable for me? I'm going to go get a job at Walmart. Then they both lose, right? So we really need like the workforce of the gig economy to be more sustainable. And that means you need to serve them with things that allow them to have that stable lifestyle, to be able to afford health insurance, to be able to put their kids into, put money aside for their kids' education, things like that. If not, the whole thing falls apart at some point.
Yeah, so it's so interesting. One of the most interesting sort of parallels to this. Have you heard of the tragedy of the commons?
I can't say I'm like super deep, but yeah.
Just the quick idea of it is that if you have a group of, say, farmers, and they're all harvesting crops, say corn, they're all expanding their farms. They're each individually incentivized to grow, maximize yield, but they're growing their land, and maybe they're collectively depleting the soil, and they're collectively doing damage, so that if they were to coordinate and say, hey, let's decide that every third year we don't farm anything because that allows the soil to regenerate. I don't really know, but they have some collective agreement then, and it benefits everyone. It requires that collective organization. And so the tragedy is that doesn't happen, and then everyone starves because they're each maximizing their individual incentives and not working together. And that's an example of this would be like climate change. Every country wants to crush it on economic growth, but if you slow down economic growth and we all benefit by not dying, then that's great. So I think that's kind of the example.
I think that's exactly right. I think these companies, the good thing about the last couple of years, especially in California with AB5 and Prop 22, is that for the first time they were forced to collaborate. They were forced to sort of band together even, cynically to put together this like lobbying campaign to overturn this law. So if you ask the labor unions, it's sort of like, almost an oligopoly behaving in its own interests. But what was really happening is that Uber, Lyft, DoorDash, who else was in on that? I think Grubhub, Instacart were part of that campaign group as well. They all have to recognize that, hey, this is a problem we all collectively face. And if we don't solve it, we all lose. We all can't operate in this state. And if it happens to take place in California, it could have ripple effects across the country. And so for the first time, they stopped looking at each other like competitors and they said, we all have the same problem to solve, right? And so there's a lot of stuff that we are sort of working towards that we think eventually they will take a similar view, that this is in the best interest of the entire gig economy. We are a beneficiary of the gig economy growing sustainably. So we should be encouraging this type of stuff happening. We'll see if that's a short-term ambition or a long-term ambition. Time will tell.
Yeah. But regardless, it seems like a inevitable effort, right? I mean, these companies.
Yeah.
I think there's an unjust psychological classification that people have, especially unions have, of companies, which is the evil empire. Like the evil Uber is going to come and they're going to exploit you, and we need to fight. And it's a little bit of. And the reality is always nuanced, but it's a little over the top in my perspective. Like the companies clearly are incentivized to make money for the payback of investment shareholders. And I do think that in marketplaces, the S-curve of return, so like in the beginning, they're not making anything, they're losing a ton of money, investors are in the hole, and then they ramp up growth, and then they squeeze the juice, so to speak. They're like apples in the S-curve.
We're experiencing that to a certain extent. That juice squeezing is happening across the gig economy. But I agree. I mean, we've never hinted at the fact that we believe that these companies are ill-spirited or bad. I think they created an industry that is being net positive, both for consumers as well as workers. I mean, there's a recent law that was just voted on in New York City, specific to gig worker rights, effectively. So the New York City is placing like a cap on the commissions that Uber's allowed to charge on delivered food and rides and things like that. They're also putting in place laws to like force restaurants to allow gig workers access to bathrooms during their deliveries and things of that nature that I think generally are net positive. But I think what's missing in these discussions is they frame it as Uber is evil, Grubhub is evil, Lyft is evil. And in reality, when you look at the users that they're trying to look out for with these new laws, these are people that otherwise may have had no access to earning capacity or employment, right? Like these tend to skew very young. They tend to skew very like heavily immigrant demographics that historically in a market like today would have had a hard time breaking into the labor market. And so, as imperfect as it is, it's often the only option for people. And I think that should be celebrated. I mean, you're creating work opportunities for people that may not otherwise have had work opportunities. And the labor unions like to come in and like bash these companies for all the ill they're doing in the world, but they overlook the fact that they have created gainful employment, or whatever word you want to call it, for tens of millions of people. And I think that's we shouldn't overlook that.
Yeah. I mean, what would be the union's response when Uber says we're just going to leave California? I mean, that has to be a catastrophic, like in the middle of a catastrophic failure. If these options are there.
This is where I see I sort of get really cynical on the motivation of unions, because the California example is perfect. I mean, if Uber had pulled out of California, the unions would have lost nothing because they don't currently represent Uber drivers in California. And so it would have been status quo for them. It's like Uber was forced out of California. They almost get to wear a badge of honor for having chased the evil out of town, but they lose nothing. They don't lose any market share. They don't lose any economics. If Uber does stay in California, they win everything. All of a sudden now every Uber driver has to join their union. They collect member dues. And so the incentives for the unions are completely misaligned, and from my perspective, that they're out advocating for things without too much concern as to the possible negative side effects of what they're saying, just in case it goes their way, so that they can sort of reestablish relevance in a new industry. Because labor union statistics recently, I think in the public sector it might still be 50+% of people are represented by a labor union. In the private sector, it's 10% and shrinking, right? There are fewer and fewer industries in North America that have labor union membership among their workers, and that's obviously from their lens not a great thing. but it also sort of questions like their relevance in the 21st century with industries like the gig economy. But
yeah, totally. I used to run a company called Home Hero. We raised a bunch of money. We raised like 24 million in venture, and we had at one point 500 caregivers on our platform. So we were connecting senior people who were hiring caregivers for seniors and the families themselves looking for caregivers. And I spoke at a conference in Los Angeles with 3,000 people that were part of this union called SEIU. I forget what the acronym was for.
Yeah, SEIU. They're like one of the biggest unions in the U.S.
Yeah. And they were pretty cynical. Like, I'm representing the company, so I'm already in this sort of tense position, and I couldn't help but feel like these people don't really care. They don't spend time, diving into the politics or the economics or the taxes or the laws. They just kind of have trust in the organization. And I mean, I'm sure they do a lot of great stuff, but the organization, just like, the expression, with absolute power comes absolute, how does it go? With absolute power comes absolute,
well, I know the Spider-Man one, with great power comes great responsibility.
Yeah. But basically, the corruption is inevitable when you have an infinite amount of power. And I think
that's something like absolute power
corrupts absolutely. There we go.
Yeah, corrupts absolutely. That's right. Yeah.
And I wonder if the attitude there is, hey, these companies have an obligation to increase the sophistication of the dialogue for the benefit of all the workers. Like, I don't hear, and maybe they do, but I don't hear gig platforms speaking about this in a way that is sophisticated. Like, are they putting out YouTube or blogs and saying, like, these are the real effects, this is how it affects us, this is what we're trying to do, this is what the union's trying to do, beware, because there could be a shadow side to every organization. And if the union says that they're only doing good for people, well, to your point, they're not admitting that you can't see what doesn't exist. And if we stifle innovation, you're not seeing the loss of those opportunities. You're just seeing, the way the world is.
And I think the sad reality is just the way the political system works in the U.S. is that labor unions are deeply entrenched in sort of every level of politics. Municipal, state, federal politics, and so when they set their eyes on an issue, it by default becomes a political issue. Uber and their peers are sort of backed into an awkward corner where they can't be like outright hostile to lawmakers and legislators because it's not going to go their way. So they have to be seen as sort of like playing nice with all sort of like the vested interested parties. The problem is that nobody stops and asks, like, hey, which one of these parties actually is primarily looking out for the interest of like the recipient of the law we're about to pass, right? We're about to pass a law that is supposed to positively change something for somebody. Who among you that's sitting at the table negotiating this law actually is looking out for the interest of that person? And I think there's this, probably overly trusted assumption that labor unions look out for workers, and I just think that it's worth questioning that, especially in the context of new industries like the gig economy that just fundamentally are architected differently compared to like what industry used to look like when labor unions were sort of in their heyday, right? So
I totally agree. I think there's a collective, there's a consciousness to any organization or corporation comes from the word corpus or body, and when a organization starts and it has a mission, like, you can fire the executive team or replace them with new people, and it still has the same mission. So like Uber is going to be doing what Uber wants to do, which ultimately is survival. It's not any different than anyone else. And if you can guarantee that, then you could add value on top of that. But it's kind of the inevitable expansion of I immediately just think of like the pharmaceutical companies and how they're just focused on growth, and like the mission is kind of secondary. It's like, we want to help people get healthier, but ultimately we really want to grow.
We want to grow the business.
We want to grow the business.
Totally.
And so you can always tell a story and justify any growth. So
and I think that's what, not to dwell too much on this labor union narrative, but what I love about building a product is that the value you create for your users is explicitly measured by whether or not they stick around and use your product, right? So, and I think it would be nice if more industries operated that way. You know, if I'm creating value for a user, a member of ours, then they will stick around. They will tell more people. They will encourage their friends to join. That's not always the case in sort of the context of labor unions. Sometimes you have no choice. If you want to work in a particular industry, you're sort of mandated to join a union. And like the link between like the value received and sort of the value contributed is not always like directly there, right? So it's in our context, gig workers can join us, they can leave us, they can tell their friends about us, they can not, and it all comes down to like, are we actually living up to our promise of helping improve their lives? So time will tell.
Yeah, and so what's the pitch? You say, hey, gig workers, come sign up at my website, and like what's...
Well, so before we get in, although we jump straight to this like labor union stuff, fundamentally our product today, I like to use the term credit union because we're a suite of banking products. We realized really early on that gig workers have a really bad, a bad time managing and accessing financial products. Either they don't have access to them because they're low credit or they're new to the country or, whatever the case might be. They're sort of seen as an undesirable customer segment if you're a big bank. And so we are a bank account for gig workers. Very common today is if you are an Uber driver who drives for Lyft and DoorDash, you could have 3 different debit cards in your wallet because Uber provides you a debit card, Lyft provides you a debit card, and DoorDash provides you a debit card. So, a third of your income could be deposited into 3 different accounts for no other reason than those channels want you to use a product branded by their, a card branded by them. And they'll give you perks like gas cash back on when you buy gas at Chevron or something, right? So it just leads to this like really silly, fragmented experience for gig workers. So we started by saying, hey, could we build a consolidated financial product where gig workers can earn all of their earnings into a single account, regardless of what app they're working for? So we support 15 apps today. Within that account, you can also get access to cash advances where if you need money outside of your pay cycle, a common use case is somebody needs $400 to repair their car because they need their car to get back on the road, but they don't have $400. We'll advance them $400 and just sort of collect it back on their next paychecks. Make it really, really easy for them to do things like that, and without ever sort of taking advantage of them or putting any type of predatory pricing in front of our customers. And then sort of beyond that, we're going into this territory of economic empowerment of gig workers through ownership. And so the first thing we did on that path is we built out a reward program that we just launched in October. That is the ability to earn stock free to the user in the companies that they work for. So Uber drivers earning fractional stock in Uber, and Lyft drivers earning fractional stock in Lyft. All with a view towards using that as a tool to not only like give more economics back to a gig worker, but also a tool that could lead to like collective corporate action, where if we organize hundreds of thousands of gig workers and turn them into shareholders, we can now use them as a voice to start, advocating for change within the context of how these companies operate. So that's sort of where our like labor union approach sort of comes into the strategy, but it's done through shareholder distribution.
Interesting how you sort of split up the different value propositions from integrating the software. How does it actually, when you say you integrate with 12 or 15?
Yeah, 15 apps.
Is that a direct API integration, or are you like scraping the email receipt, or how does that work?
It's an indirect API integration. I mean, we work at a company called Argyle that sort of sits between us and the user's profiles. Argyle, if you're familiar with Plaid, Argyle is very similarly architected to Plaid, where you use Plaid to like go and like get banking information from a user's bank account without having direct integration into that bank. Plaid is a sophisticated screen scraping tool, right? So in our context, an Uber driver, well, let's say a gig worker with 3 apps would create a profile on Moves. They would be inputting their username and password on each of the apps that they use to earn money. Through Argyle, which we have an API integration into, we're effectively getting data from their profiles. So on an almost real-time basis, we see when they've completed a ride, we see when they've earned money, we see when they got paid out. And so we can organize all that into a dashboard for the gig worker to see their earnings across all their sources. And then we'll be able to, do more interesting things on top of that. We help them understand the schedule of their cash flow, like when does Instacart pay out, when does Uber pay out, when does Lyft pay out, so that you know when your next paycheck is coming effectively. And then from there, we'll prompt them into like, hey, do you want to organize all your earnings into a single bank account instead of the multiple bank accounts that you use today?
Yeah, that makes a lot of sense. It seems like a no-brainer from the driver's perspective or the gig worker's perspective.
I hope so. I mean, I think one thing that we're learning, it's going really well. I mean, we have users in all 50 states. We've been in market for about 6 months. The one thing that I maybe didn't fully appreciate right off the bat is the time it takes to establish sufficient trust to really like take over the financial relationship in a person's life. Like, as much as we like to make fun of banks have trusted brands. They might be hated brands, but they're trusted brands, So, and when a new entry comes into the market and says, hey, trust me with your life savings, it takes time to establish that trust with the customer. And so that's just a constant working progress around making sure that when they see moves, they see a brand that, speaks to their lifestyles, understands their challenges, and also has like enough durability to stick around and continue giving them access to products that they need to live their lives.
How much have you guys raised in funding?
Just over 10 million.
Yeah, I find that also helps when startups
of course.
raise.
Yeah.
It's like kind of stability.
Yeah, no, definitely. And at the end of the day, from like an absolute risk perspective, it's very manageable. I mean, like embedded in our product is a bank account and a brokerage account. We have a brokerage thing for the stock rewards. The bank account is issued and managed by a licensed chartered bank, right? Like we're not a bank ourselves. We partner with a bank. If, one day to the next moves evaporated, it's not like the user's money is evaporated. There's a licensed bank with FDIC insurance on the account sitting behind the hood or under the hood. And then similarly on the brokerage side, like there's a licensed broker dealer that is opening these brokerage accounts in the name of these users. Like all of the money is secure from like a pure legal perspective. But they need to establish trust in the brand. They're still interacting with us when it comes to like customer support, when it comes to like the user interface of our app to effectively give them the features that they need to sort of access their money on a day-to-day basis. But there's no like worry or risk of like my money disappearing. Like that doesn't exist.
How did you do that? I'm curious from a technical perspective. Do you go to are there banks out there that specifically brand themselves as having this like back office feature?
Increasingly there are, but more specifically, I think what makes it easy for companies like us is there's a growing segment of companies that just live sort of in between the bank and the consumer fintech. And so broadly, these companies have called themselves sort of banking as a service or fintech as a service. They're API companies. They integrate to the bank on one end, and then they provide that product suite to consumer fintech companies through a set of APIs effectively. And so we work with a company called Unit. Unit is a software vendor that we plug into. Unit is plugged into this bank behind the hood, right? So Unit goes out and negotiates with this bank and says, hey, we're going to make it really, really easy for fintech companies to build on top of your infrastructure. And we'll share the economics in some way with the bank. And then they go out and they sell to 100 consumer fintech companies, and the bank is effectively growing their deposit base and they're growing their footprint by extension through these consumer channels. And then we, as the consumer fintech, we earn the majority of our revenue off of the interchange revenue. So when somebody's using their card, we're earning, call it 80% of the interchange derived on that transaction. And then the other 20% of the interchange is being split between Unit and the bank. The bank is primarily in this business because they want to grow their deposit base, because their deposit base is what allows them to lend, right? So they might see their primary business like mortgage lending or consumer lending, but they have a cap on how much they're allowed to lend, which is determined by how many deposits they manage as a bank. So any channel they can go through to grow their deposits, then they can grow their lending book effectively. So,
interesting. And so you guys are focused on the interchange as a revenue source?
That's our primary revenue source, yeah. And then it's also the interchange revenue that allows us to fund things like the stock rewards. So we're using interchange revenue to pay for the stock to give to the customer. So the customer never has to use their own money. And then similarly, we're in the process now of negotiating some like perks so that we can do things like cash back on gas purchases and car maintenance. And those tend to be funded by the merchant who, let's say Chevron gas station, wants to acquire customers. So they're willing to give away 4% of their margin to acquire customers. And then you can give that 4% back to your customer, or you can give 3% back to your customer and keep 1% yourself. And there are companies now like connecting these networks of like merchants to channels that are acquiring customers. And so you can offer things like cashback perks for free, and or it's a revenue generating item for the business, for us as a business, to be able to pass that along to our customers.
Man, that's super interesting. Do you think there's a play here on using blockchain and maybe cryptocurrency? I specifically think about it in the ownership. Like, I wonder if the future of marketplaces, like even take the gig economy with driving or shopping or something, like the company that displaces Uber and displaces Instacart, I tend to think is going to have an infrastructural advantage where imagine, you sign up imagine the founders are taking, similar to a protocol on crypto, the founders have 10 to 20%. And then instead of funding the company through private investors, you have a pool coming in through outside sources, which individuals who are buying the token or people on the platform who are investing and owning a portion of it. And that's liquid. They can go in and out of that investment. But the fuel for the fire, the money for growth capital, comes from both the providers on the platform and then other like liquid outside investors that don't own, well, they have to own a percentage of the company. But I do think that there has to be a model that is decentralized in ownership. So, you know, like if imagine every Uber driver that's on there for the duration of time that they worked, maybe by the amount of money that they made on the platform, owned a percentage of the company. So say you take 70% of the company and then all the drivers own a percentage of that based on how much they earned. It would be a much different relationship between, it would almost be like the two merged together.
So you're speaking my language. I tend to not talk too much about this because for most people this is like complete science fiction, but that's what excites me about this business. Like my background being from the crypto industry, that's what I saw when we started building this. Was I think there's a model. I don't take it as far as you do. I don't think the model in my mind replaces Uber. I think there's a model that sort of complements Uber over the long term. Like this is another industry where I think the incumbent power is cementing itself. Like I think the longer Uber exists, the longer it will exist, because it's effectively gaining these like moats that in some cases are regulatory moats, in some cases are, brand moats. But all that to say, I think there's two aspects where decentralized ownership comes in. So one, we as a business can decentralize our ownership. This is why I call ourselves a credit union. I think the most like pure form of like consumer cooperatives as an ownership model is where we'd like to evolve, where customers of ours will own us. How they own us, what that ownership is associated to, what rights are they granted with that ownership, but some way to provide economic and sort of governance related ownership to our users. I think what historically cooperatives did not have that sort of limited the value of ownership was liquidity. So if you can create a model of liquid ownership, then I think the implied value of whatever it is that you own goes up just as a result of that liquidity. And so, we're a credit union, or we're building a credit union from that perspective. We want our business to be owned by our customers, and we'll find some hybrid way to root that into a legal real world structure, right? Like you still need this to exist in the real world. It still needs to have a bank account. It still needs, so you can't be operating sort of like on an Ethereum based DAO purely, because there's still bank accounts being opened, KYC being done, and things like that. The other aspect of ownership that I think that naturally evolves to is this idea of like worker cooperatives. And actually this is something that during the AB5 debates in 2019, there was a law that was drafted by this special interest group that never really had much legs, but it was called the Cooperative Economy Act. And the Cooperative Economy Act was a counter proposal to AB5. And it effectively said, hey, the solution to this problem is for us to create cooperatives of workers where the drivers get together and they create this legal structure and they own the legal structure. And in that legal structure, the cooperative would contract with Uber, sort of corporation to cooperative. And that cooperative would then distribute the wages to its workers that were owners in the cooperative. But it was sort of like an old school, like clunky way of doing this with these like old school cooperatives. I think we could theoretically evolve into being the cooperative that captures all labor in the gig economy. So if you want labor as a marketplace, you will be interfacing with our cooperative. How that translates into economic value for our workers, I mean, is probably TBD. Does that mean you're like writing a contract with the Moves, like we call it the Moves Collective? Or does that mean you're contracting directly with the worker, but you're giving some supplemental value to the cooperative because the cooperative is funding benefits, it's funding education savings for workers' children, it's funding retirement savings. Like we'll see what those models look like. But effectively, I think we get to a place where if you're a laborer in the gig economy, you join this cooperative. And as a member of the cooperative, you earn ownership. And that ownership is liquid. You can sell it when you want to sell it. You can go in and out of that position. You can accumulate more ownership the more you consume the cooperative services or the more you contribute to the cooperative. And I think all of that powered by a token is effectively the only way that you could do that because it needs to be really, really dynamic, right? Like I think the problem with these old legal structures is they're very static. To issue a unit of ownership in a co-op, 10 years ago was literally a piece of paper. And so you couldn't do that very dynamically and you couldn't create a market for these things very easily. But I think that all changes with the introduction of crypto.
I almost think you could keep going with that, where you say, okay, if you're in the business of creating these tokenized co-ops and you get good at it from a gig perspective, you could look at the business as, and this is just riffing, of course, but you could look at it as you're in the business of creating co-op infrastructure. So now the gig is one area, but there's many different areas where there could be co-ops, and they could be local co-ops on farming, they could be on transportation, it could be on, anything really. And if you wanted to create that like fractional tokenized ownership, and then I could imagine like the owner or the creator, whoever is developing the co-op, could have different a user interface for different choices. Okay, I want there to be a completely unanimous vote. I want there to be, a signed vote on the blockchain. I want to give preferential voting power. And you just, you could set this in the initial contract, and then like people could just create that. It's kind of like a.
Yeah, I think there's I think the use cases are pretty endless, and would I don't think we're going to become the B2B like build your own co-op business, but I think the gig economy is a really interesting industry to prove the concept because of its characteristics, because you already have these one-to-many relationships where that Uber driver also drives for Lyft, also drives for Grubhub. So naturally, they're not like tied to one channel over another. They're pretty flexible. And so I think that characteristic lends itself really well to this model. And then if you can find a way, so then the co-op not only gives ownership to its users, but the co-op also accumulates ownership in these companies, where you get to a point where you fast forward 10 years and the co-op actually is a major shareholder in every public gig company out there. And so it has this disproportionate leverage to be able to negotiate things that are in the best interest of its users. And I think that sort of like rebalances the equilibrium of the supply and demand of the gig economy, because I don't think we're at that equilibrium quite yet in terms of the supply side of the market sort of getting a fair deal out of the equation.
Yeah, wow, that's super interesting. I don't know if I've fully wrapped my mind around that, but because I tend to carry the mental model of the free market, the providers in a free market meet the demands of the consumers being the gig workers. And so if the gig workers are like, hey, Uber, we're not going to sign up for you because we know you're not going to give us your data, like eventually, as you say, Uber will allow people to download their data right off the bat. So there's this natural, like, it may not be instantaneous, it could take months, even years for companies to realize where that value exchange is. It
takes a huge amount of capital, right? Like there's a good example in New York. There's a product called the Driver Cooperative. It's effectively a direct competitor to Uber, and it's owned by its drivers. It's just because they're a co-op, they're legally speaking a co-op. They don't have a model to raise outside capital. They're purely funded on donations or member contributions, and bearing in mind that their members are like low-income drivers, right? So the amount of capital they're able to scrape together to build a product that is one, like compelling enough to a consumer to download instead of using Uber, compelling enough for a driver to feel like they're getting like, and then you need to get to a certain network effect so that there's enough demand pumping through these marketplaces so that when you turn on the app, there's a ride waiting for you. You don't have to wait 15 minutes for that next ride. And like all of those things is where Uber has this like embedded advantage, right? To be able to get to the scale of Uber and compete at that scale is like a multi-$100 million proposition, right? You can't just like overnight sort of bootstrap your way into a competitor of Uber, just given like how established they are now. And that's where I think you're going to run into challenges with these alternative models. But
Yeah, wow, that's crazy. I didn't realize that. You don't remember the name of that one, do you? Off the top of your head? It's not View, is it? Or something with a
no,
V. There was one in New York I used that was pretty janky, and I was
I
like,
think
oh,
it's
this
called
feels a
Driver
little
Co-op. Like I think
really.
if I
Yeah.
remember, like literally drivers.coop. Let me check if that's right. Yeah, drivers.coop, the driver cooperative.
Do you think? Have you
100%
seen
worker.
the Tesla taxi product that they pitched? They talked about this a year ago, but they're like, yeah, if you have a Tesla, you'll be able to open up your phone and put it on taxi mode, and it'll just drive around, and
Yeah.
people could hail it. And I'm like, ooh, I think companies, the natural evolution, unless you work really, really hard to avoid it, is that you find an innovation, you develop it, it grows, and then it becomes obsolete, and the next thing kind of comes. Like there's this natural birth, growth, death cycle of companies, and you have to fight like hell to not die and innovate. And so Uber is like, trying to do a ton of stuff and driverless cars because they know the future, but it's really, really hard. Yeah.
Yeah, and I think Tesla's an innovative company, but there's a certain amount of like sticking to your lane in terms of what you know well. Like I think Uber and Lyft both made this mistake 10 years ago when they started their businesses. Or maybe not a mistake, but they didn't foresee the future that they created. What they thought originally, if you listen to like early interviews of the founders of these two companies, is they thought they were going to be doing exactly that. They thought they were going to allow people who owned cars to sort of use their spare hour in the day to like hop on the road and make a couple extra bucks. But what they didn't realize is that they were going to be creating a permanent full-time workforce. Uber's never contemplated a permanent full-time workforce. Lyft never contemplated that. So I think this idea that it's going to be the supply is primarily going to be people with like a spare hour in the day where they have a car that's got no people in it and they can just like turn on taxi mode. You might find a few people that do that for the fun of it, but that's not going to be like the lion's share of the supply coming into these markets. And then these people that have this asset, this car, they want to optimize that asset as much as possible. Sometimes that's picking up a passenger, sometimes that's picking up food, sometimes that's picking up an Amazon delivery, like whatever it is that allows you to like earn the optimal income in that car for that hour or that day. That's what you're going to do. So you're going to need like a market of options available to you. And that's why you have, you've got Uber drivers that while dropping off and picking up passengers have Amazon packages in the backs in the trunk that they're in the process of delivering so that they're earning that Amazon earning while they're earning that Uber earning at the same time. So you need like this sort of like optionality in marketplaces to be able to like create these like optimal outcomes for these workers. But
Yeah, boy, driverless cars change all this stuff. It's like,
yeah, we'll see. That's the question that I don't have a good answer
yeah.
to. But
God, it does feel like, because so much of gig workers are. I feel like I don't fully understand the difference between gig workers and freelance. The idea of gig workers is that you turn it on, you're active, and then there's a job, you fulfill it and complete it. Versus,
I think that's right. Yeah, I think it's some combination of like the types of skills required are maybe a little bit more commoditized. Like you have a driver's license or you own a bicycle or whatever. And then the idea that the quality of your work matters a little bit less. Not to say that it doesn't matter, but if you're a freelance photographer, before hiring you, somebody's going to go through your portfolio. They're going to read your reviews. When you order a burrito on Uber Eats, you don't stop and pay attention to who's the guy delivering your burrito, right? Like it's just sort of it's a binary equation. And so I think that's the characteristics of a gig worker to us is like you turn on the app, you earn money, and like your reviews only matter so much. I mean, they matter in the sense that you could get delisted from the app if you don't maintain a certain star rating, but nobody's choosing to hire you or not hire you. Nobody's stopping to like pick what driver shows up to give them a ride to the airport, right?
I want to ask you one more thing. Do you have a couple minutes? Okay.
Yeah, of course.
Do you support universal basic income as the concept of we take tax revenue as it currently is, and then we give everyone in society the same amount of money every year. Just call it $10,000, $5,000, universal income for everyone. Or if not, is there a spinoff that you do support?
Yeah, I mean, I think there's so many varieties that people have been debating. I think in its simplest form, I worry about the unintended incentives that are being created by just giving people, and I think we saw a little bit of this during the pandemic. And I'll say, with more experience in Canada, where we effectively gave away UBI for a period of time because we had a very consistent check going to people every single month for about a year. And the resulting effect of trying to get people back into the workforce after they had just sort of become dependent on these government checks that kept coming. So I think in its simplest form, I worry about that. I do think that there are ways to get more creative with the incentives. I don't think it needs to be that binary. I think there's ways to design something that has better outcomes. There's another concept that I'm a little bit more bullish on that I think a few people have been calling universal basic capital. And it's this idea that historically, I guess, people that form the labor of the market tend to not be very exposed to the capital of the market. And so people who own businesses are not the same people who work for these businesses. And so if you can give more ownership into the hands of the worker, then you create better economic outcomes for those workers, but you also incentivize that long-term sort of work. You incentivize a career's worth of work, but with the ability to accumulate wealth and the ability to sort of feel like you're on the winning side of the equation. And so, naturally that fits really cleanly into the thesis of what we're building. But this idea of labor meets capital, and labor starts to accumulate capital so that a greater percentage of the capital in the market is owned by the laborers of those companies. I think that would be a really interesting income that sort of is beneficial for everybody involved.
Yeah.
But
I feel like
I haven't thought through all the details.
I feel like
of that,
the reason that wouldn't happen today is I'm thinking about in the U.S. there's a S corp, C corp, LLC, and these are broad legal frameworks to allow you to create companies, but they're not easy to just fractionalize. If you wanted to start an LLC, you have. It's very difficult to just give people, a 0.1% of a company or 20% of a company because you're tied to tax implications and all these other things. Yeah. So the C Corp is dedicated to that, and that's why funded companies go the C Corp route. But the problem is that most business, I was actually just looking at this last night, the number of C corporations in the United States has been steadily decreasing since 1965. And the number of partnerships and LLCs, S Corps, has been increasing. And the difference is that C Corps have a double taxation. So C Corps are taxed, and then they pay their employees, and then those employees are taxed income tax. So it's like two levels, yeah. Whereas the partnership and the S Corp are there's just one tax and the income of the people. So there's a big incentive because of that tax structure in the U.S. at least. C Corps are going down and partnerships are going up. The problem is that you can't fractionalize partnerships easily. So if we have 50 employees at a bakery down the street, I can't give them a percentage each. I have to start a C Corp, but in that case, everyone's double taxed and it's a lot more expensive to operate. Yeah. So my basic view is that we need to cut the number of rules in society in half, or maybe even more. The number of I was looking into tax forms last night or tax history, and the number of words in the tax document has gone up by it was I tweeted this out, but it's 10x in the last 30 years. So it's just way more complicated than it used to be. And I think that slows things down. We can't iterate on ideas quickly enough when things are really, really complicated.
When I told you that was my background before becoming an entrepreneur, as I was a tax consultant at Deloitte. So I spent years and years and years just learning tax law, which is a really boring thing to say.
Man, it's super interesting. I find it interesting.
But no, you're exactly right. I think one of the big inefficiencies in the market is the bureaucracy and the rules and the legal structures that surround sort of how you might want to most efficiently create positive market behaviors. But then you have to go through all these legal hoops to get there. There's a little bit of movement. Again, going back to the crypto space, I think in its purest form, you have these ways to coordinate capital and coordinate people without all this like, all this legal and bureaucratic like mumbo jumbo to jump through. I'm sure they will get it wrong, but there are some jurisdictions now starting to provide like legal structures for like DAOs to register. I think Wisconsin, if I'm not mistaken, is the first state in the U.S. to like legally recognize DAOs as a legal entity. And so if you can find ways to use some of the technical advantages of these new crypto coordination mechanisms and then somehow tie them to the lightest weight legal structure possible, so you're not like overburdening yourself with paperwork and tax implications and things like that. And then what you really want to innovate on is like the experience of how you fractionalize and distribute that ownership and like what rights you associate to that ownership. Because right now you sort of have like one of 3 or 4 templates that you have to fit into. And I think that's like there's lost innovation there where you're not allowing people to innovate on the structure itself. You're saying, hey, you have to live within one of these structures, and all you can innovate on is like the service or the product that you deliver. But I think there's a lot of room for innovating on the structure, right? Like how do you, and the incentives you can create by getting the structure right. But governments are going to have to wrap their heads around like, well, how do you regulate for that and tax around that and things like that. So
it always comes back to tax. Yeah. So it's like, how does the government collect its money so it can do its thing? Because if that's not possible, then there's no, that's table stakes. So.
But I'm bullish on this idea of like cooperatives meet DAOs, however you want to think of that. I think there's a lot of room there, and I don't think it's only in the context of like, labor union movements and worker cooperatives. I think there's a lot of space, like you said, like that bakery that wants to give ownership to its workers. Like, I think there's, there have been some movements around just like worker cooperatives, but again, old legal structures with like lots of complicated paperwork and tax implications, and like, it blocks a lot of innovation in this.
Yeah, that's a good gut check. It's like, there is some purpose to this. I mean, say for someone who doesn't know anything about this, it's like labor unions have been around for a long time. So somebody cares enough to work hard enough to keep them alive. They provide value in the market, but they're so antiquated in that the way that they engage with the legal framework and the people and the companies today that it to me, it seems obvious that there would be ways to remix this for today's world and crypto and blockchain and gig economy stuff. Yeah.
Well, here's hoping. We'll see.
Man. Well,
I'll let you know.
Congrats on all the progress, Matt. I really enjoyed this conversation.
Thanks,
I really, love to riff on the intersection of these areas, and it was a lot of fun.
Yeah, ditto. No, this was a lot of fun. Thanks for the time,
All right,
Mike.
take care, man. All right, take care, man.